Joining us from RBC Capital Markets, Michael Cloherty. Michael, good noon to you.
Hi, how are you?
What does it signal to see the two-year yield really pushing against that 0.33% yield?
Yeah, it is. It means that we've basically taken out all Fed tightening for the foreseeable future right here. Not just this year, but next couple of years, we've removed almost all of it right now.
Are you willing to say, as Tom Porcelli and you willing to say that the Fed will not raise rates till 2014?
Yeah, no, I think it's a little bit premature for that. Again, it wasn't that long ago we were priced way too far the other way, with significant tightening priced in. Now I think we've come a little bit too far. It's very hard to, if you look at a expected pace of tightening over the next couple of years, to justify twos this low, particularly because as much as the funds rate is going to rise, we think financing rates on Treasuries are going to rise even faster.
Michael Cloherty saw Sound of Music 14 times. Climb every mountain is our dreaded first chart. There it is. Here's what's important here, folks, the difference between the 2-year and the 10-year. Look how pointy that steep yield curve is in the 90s. Look how relatively pointy it is. I'm telling a story here. Leave me alone, Rex. Look how pointy we are 10 years ago, and look how thick, how sustained we are here with a steep yield curve. Michael Cloherty, what does it mean that we have been so long so steep?
Well, I think there's two factors. One is simply that the Fed's taken rates down near zero. Whenever you get that much of a policy move, people expect that policy move will be unwound over time, so it has a much bigger impact on shorter maturities than longer maturities. That means it drives it down the 2-year yield more than it drives down the 10-year yield. But this has been even excessive relative to the policy change. We think one of the things that's going on here is there's been a huge shift from private sector borrowing to U.S. Treasury borrowing.
Right.
If you look at where on the yield curve those two borrowers, where they actually do their borrowing, the private sector people tend to borrow fairly short. Credit cards, very short maturity. Most corporations end up borrowing fairly short. Where the U.S. Treasury borrows at much, much longer maturities. So when you shift from private sector borrowing to public sector borrowing or U.S. Treasury borrowing, you're shifting the financing burden dramatically out the yield curve. We think that's one of the things that has been keeping the curve relatively steep here and is going to keep it steep going forward.
This is a terrific insight. Watch my hands. Michael Cloherty, when you look at where they buy at the 10-year space, how far around that 10-year maturity does that QE2 buying affect the market? Is it 6 months wide? Is it 2 years wide? How far around 10 years does Bernanke influence the market?
Well, I think he has impacted it all the way out, even well beyond the 10-year maturity. But the strongest point, if you look at where the bulk of the buying has been, about 5.5 years. That's been the most concentrated point for them. So I think that's where you've seen. That's actually, you see the 5-year point of the curve seems relatively rich relative to the shorter and longer maturity segments, with the Fed partially responsible for that.
Let's look at this chart here with Michael Cloherty. This is money for nothing. It's a new chart. We've been showing you the real 10-year yield. This is shorter maturities. As Michael was saying, that's where we play the real 2-year yield back to 1976. And you can see how unusual it is where we are now. Michael, can I say that this very low real yield in the 2-year is the all-time free lunch for the economy?
Yeah, that has been one of the things is while rates have been low, while the cost of borrowing is down, we still have limits on who can borrow right now. Credit standards are still significantly tighter than they had been. They needed to tighten somewhat. We were too loose before. Now the risk is that we've swung a little bit too far to overly tight standards, and that's limiting how much of an impact on the economy these low rates are having.
Michael, where's the 10-year going to be a year from now? What is the RBC forecast? Have you changed it recently?
No, we still think that rates are going to rise significantly here. We think that the economy has slowed down a bit, but 10-year through 3% is pricing for a dramatic slowdown. That's extreme weakness, real double dip recessionary threat. We don't think we're going to get there. We think, we've had a bad month of data. We actually had some decent data in the first quarter. So we think this is a slowdown, that lower gas prices are going to help consumer spending a little bit. We don't think growth is going to be great, but that will squeak by enough that you just can't justify 10-year notes near 3% anymore, and think we'll head back up towards 4 over that time frame.
Where do savers hide?
Yeah, and unfortunately, there's no great option right now. It's very tempting to try and creep out to longer maturities to pick up some yield right now, but you are putting a significant amount of capital at risk. If we do get a sell-off taking those longer durations, you could actually be underwater pretty significantly very fast. So unfortunately, I think it is huddling towards the front of the curve in those extremely low yields and just waiting for an opportunity to buy at higher yields.
Earlier this morning, folks, on Bloomberg Surveillance, I spoke with Christopher Rupke of the Bank of Tokyo Mitsubishi, and I asked him, can we declare an end to the phrase I hate so much? Can we declare an end to soft patch?
I'm a little concerned that the initial jobless claims are elevated here, so that has to come back. But the soft patch we had last year is kind of my model for what might be happening at the worst, and that was a slowdown of 3 months.
Chris Rupke there. Michael, does history repeat itself? Is it just a summer redux, or is there something more going on here?
I think that most likely this is just a brief soft run of data. Aren't ready to think that things are really dramatically and permanently weaker right here yet. If you look, we've had one weak employment report. Even that weak employment report wasn't as bad as what we were having a year ago. And some other soft ISM data. Again, that's not quite enough yet to throw in the towel on the recovery here. We think it is still going to bounce back a bit.
Certainly the surprise of the week, Michael, this oil news yesterday. What a great conversation with Doug Terreson. Bring up note of the day, Terreson of ISI, Ed Hyman and Nancy Lasar's shop. He sticks, Michael, with oil still expensive. Multi-year inventory declines, high utilization, OPEC budgetary needs, prices remain healthy. How did you and your fixed income desk respond yesterday to the decline in oil prices?
Well, I think it did a couple of things. One is, we saw on the inflation-protected securities tips, the shorter maturity tips did very poorly on that news, just as we saw the drop in oil. But in addition, again, I think that does give us a little bit more cushion for growth. Under some of the traditional rules of thumb about the relationship between gas prices and consumer spending, we think this is going to add about 0.3 to third quarter economic growth. Now, that's sort of a one-quarter effect. It's not likely to persist for a long time. This isn't a fundamental change that happened with the release of oil yesterday. But nonetheless, that does serve to be a little bit of a buffer about these double-dip fears out there.
Let's bring up Elegant Chart 1. This is the quiet story of the week. I featured this a few times, particularly on radio. This is a complicated chart and needs some discussion. Michael Cloherty, Dublin on a path to Athens. The white line is the Irish-German spread. The yellow line is a more newsworthy Greece-German spread. We started at the same point a year ago. Ireland has accelerated much quicker than Greece. Ireland, Michael Cloherty, is closing that Greece angst, that spread gap, much quicker. What did you learn this week in Portugal, Spain, and Ireland as we are all focused on Greece?
Again, I think that Ireland has really changed the course of the debate in some of these other countries, because Ireland was extremely aggressive in budget cutting when the crisis first hit them, much more than the other countries. As a result, their economy slowed a little bit more than anticipated. So that's I think that is weighing a bit on how deep some of these other countries are going to be willing to to cut their budgets. Next week, first half of next week, we'll probably get a vote on to see whether Greece is going to approve some of the budget cuts. So that's going to be critical. I think we'll continue to remain focused on Greece until we get past that event. And then beyond that, you will start to see some more attention to other countries, including Ireland.
Yeah, I totally agree with that. Look at this chart, folks. This is just the Irish spread. This is one of those lines we just showed, except it's just the pure series. The 90s, the complacency, the boom of Ireland, and then you can see the explosion up here. And the story this week is my finger's on 8%, and there's 9%, and we really just vaulted ever higher on Ireland. This is perhaps the next story after Greece. So I want to show some good news here. Let's look at Switzerland. Michael Cloherty, what a success for the Swiss economy. Too much information. Bring it up here. Switzerland, real GDP. I was stunned by this, Michael. I really didn't realize how well Switzerland has done in sustaining GDP and being in recession for such a short period. Does their game plan change with that strong Swiss franc we observed this week?
That's what's really been astonishing, is that they've been able to hold up their exports despite the strong currency right here. And we think that some of the products they're involved in, certain high-tech things, things like that, are a little bit more immune to exchange rate swings than some of the more commodity-type products. So we think they can withstand a little bit more currency strength, but it has been an issue that's been popping up for them.
Michael Cloherty, thanks so much. RBC Capital Markets.